Yeah, well, look, we're about to talk about this time is different with JP Morgan, but I just have to say, I was reading about Morgan Stanley. You all remember the bear, Mike Wilson? It's like, pick good growth stocks, but not the Magnificent Seven. They're going to disappoint. So kind of an interesting twist. And Jim Cramer has the Jim Cramer six-pack, which excludes Tesla, which I have to say, probably one of the most bullish things I've ever heard from Jim Cramer for Tesla. JP Morgan just warned that this time is different, but the way they said it was quite different. Yeah, quite literally. Yesterday, I went to a JP Morgan economics event. We were invited. We're members of the private bank. House Hack is a customer of JP Morgan. It's pretty cool. It's the Year of the Dragon, so they hand out these little Year of the Dragon envelopes with gold coins in them. They're chocolate, obviously. But anyway, kind of cool. So, look. They had an economic event. We talked to the person afterwards as well that was presenting, and I wanted to give some of the ideas. So, first of all, you have to understand also where their bias is coming from. Their bias is coming from selling you treasuries, which is not necessarily bad advice. Right now, it's probably a good idea to buy treasuries, not personalized financial advice for you, because once we get into a rate cut cycle, yeah, probably yields will fall. It's also known that usually after a Fed meeting, we see about a 60-point drawdown in treasuries. And so far, we today have a 12.6 basis point drawdown, following yesterday's 7 basis point drawdown. So that's already 20 of it. So we're already seeing that. 10-year sitting at a 3.84 right now, and the 2-year down about 5.5 bips at 4.17, which actually means the inverted yield curve is getting worse. But look, from the point of view of having a laddered treasury portfolio, is it probably better than money markets? Yeah, because you might get some capital appreciation and lock in some of those higher yields. It's not a bad point of view. But what did they warn about the economy? And this was the part that was shocking to me, because it is an interesting point of view that we don't hear that much right now. We hear the binary. We're either in a recession or we're not. I was highly worried about a recession in January of 2022, which is actually the last time I went to one of these JP Morgan events. And I'm the person going, we're about to be in a recession. Little did I know we were actually already in a technical recession. Q1, Q2, 2022, both quarters of negative GDP, boom, technical recession. Already happened. So is it possible the yield curve uninverting is a little late? Is it possible the inverted yield curve sets us up for the recession we already had in 2022. I mean, after all, look what the stock market did in 2022 compared to where it is today. And we do know historically stocks hit their bottom around the time of a recession. But the interesting point of JP Morgan was that we might be in this rolling recession, where at the end of 2022, you've got the technology and chips recession. Remember when I launched my ETF and everybody was making fun of me for being chips heavy? Yeah, oops, chips were a great play. Now, you ended up in a freight recession after that. Massive layoffs in freight. You're still seeing it today. You've got UPS laying off 12,000 workers, but they're well out from their bottom, where freight was in a pretty deep, dark recession there for a moment, and bankruptcies as well. Then you get into this manufacturing recession where we're in right now. And essentially, you have these cycles of everyone. This is his argument. You have these cycles of everybody during COVID makes more money. But then coming out of COVID, everybody has their sort of negative period where it's like we're normalizing, but everybody has their own little recession. And because they're kind of all happening at different times, you don't have a concentrated recession. Interesting point, because think about it. In the dot-com era, technology bubbled up, but did it really affect real estate? No, not really. What about the Great Recession? Yeah, real estate got destroyed to the tune of 40 to 55%. Single family was somewhere around 40%, 45% certain markets. Multifamily saw about 48 to 54%. And then condos got smashed even harder. Not exactly sure why, but probably because of defunct HOAs and problems you get with HOAs managing buildings and insurability, and also condo underwriting. Probably the reason some condos got smashed like 60% in valuations in '08. It was crazy. But point being, our real estate crash hasn't arrived yet. And even though we expect that multifamily is going to go through a pretty big re-underwriting, as a lot of multifamily apartment buildings are starting to basically hit their loan deadlines, especially new construction developments, where now you've got this flood of new apartments Apartment rents collapsing, great potential opportunity to buy. That's what we're doing with House Hack. Right now we're in negotiations on a deal with a massive how should we put it? Over 8-figure defaulted loan. And it's like, this is very interesting. Point is, the idea of a rolling recession is potentially propped up by fiscal spending and our debts going ridiculous, which means maybe we will be considered to be in a wide recession during all of this time, 2022 to 2023, but it'll be this weird long recession where after the fact we're like, yeah, we were in a recession all along. And it's just sort of this petered out, every market sort of went through their own little disaster, or just no recession, which is weird. But the fact that we can define recession after the fact is the bizarre and scary part. Now, what else was very interesting is comparing what happened in the Great Recession to China. This is something else JP Morgan warned about. They talked about how our Great Recession in America was based on a bubble in real estate and then a banking crisis as a result of credit derivatives on home loans. Basically, think about it this way. If you had a $100,000 home loan, you bundle them up with 10 different home loans. Now you got a $1 million portfolio of home loans. But then people take out credit default swaps and derivatives basically on that $1 million home loan package that could be sliced up to a bunch of different investors. And now you're actually trading somewhere around 10x the value of the underlying loan through a derivatives market, which is just a fancy way of saying the loans were $1 million. Now they're being traded on the market at 10 mil. So when 30% of these loans defaulted and that, $1 million loan became 700K, you didn't lose 300K, you actually lost 3 million, and that amplified, or potentially more, because derivatives can swing the opposite direction substantially faster. Not necessarily in the same proportion, right? You might have seen that 10 mil go down to quite frankly, an alignment. 1 mil or 700K in value, massive losses where you're seeing 90% losses on some of the derivatives. So what's interesting about what they brought up with this is they actually compared that to China today, and they said that China is way worse. That China, it's not just housing, it's everything. Now, contrarians look at that and go, perfect, it's the time to buy the dip on China. But a lot of folks are like, dang, that's an interesting comparison. That our Great Recession focused on housing and banking is nothing compared to the hell that China is going through, where basically every level of the consumer is getting destroyed. I mean, look at what we had on eHack about Starbucks. So you look at Starbucks, they're adding stores like crazy in Starbucks, but especially in China. But what are you specifically seeing with comp sales? Well, specifically, you're seeing negative comp sales in China. So the only reason volumes are going up is because you're opening more stores, but people are spending less per ticket in China. Very interesting. Sort of a little measure of what's going on with Starbucks in China. But more importantly, this JP Morgan analyst was essentially arguing, look, every industry is going to go through its recession. And we've already seen a lot of industries bottom out and come out of that recession. That explains why we've got the stock market led by tech at a multi-year high, or all-time high, frankly, because tech's already gone through its recession. Now we'll see. We got Apple earnings today. That'll be interesting. Google earnings came out. The stock dropped 7%, but they actually weren't that bad. It just wasn't as optimistic maybe as speculators had hoped. You started having a little bit of miss on ad spend, which is a big concern because of AI robbing Google of AI spend. But I mean, look at the frickin' stock. Who cares? It's already green again, 85 bips. So the meeting, all in all, I think was fascinating because you have this POV of, look, rolling recession, you have China in the doldrums, and you have really a Fed that in their mind is steering the economy towards a soft landing. Now, I had problems with hearing, when we start comparing to other decades, hey, well, what about 1982? Hey, what about the 1920s? And we're comparing to other decades. And one of the responses we got was, well, everything's an exception in this environment. The fact that we've got geopolitical issues, war with Russia, Ukraine, a pandemic, followed by the amount of fiscal stimulus that we've gotten. Sure, we can compare to different periods. We can compare to post-Spanish flu. We can compare to post-World War II inflation, Korean War, frankly, disinflation there for a period of time, and you were below 2% inflation in the 50s. There are comparisons to the 70s and there are comparisons to the 80s. But that left me a little concerned because when I hear this time is different and it's okay if you have a long run horizon to buy stocks or treasuries and stay away from the foreign markets, when things are at all-time highs here, I'm like, I don't know, man, I don't know. But it was an interesting point of view and I wanted to share it with everybody here. I don't disagree with rolling recession. So I'll give you my opinion now, okay? That's their opinion. Now I'm going to give you my opinion. I don't disagree with rolling recession. I think we're going to see substantially more joblessness than we've seen so far, more layoffs. I mean, even Okta just laid off more folks today, but who knows? Maybe that's isolated in tech, and is that really that big of a deal? I mean, we go to ehack.com, and don't get me wrong, we want to be sensitive to people losing their jobs, but look at ehack.com, we threw the layoffs chart, and we're really not at this highly abnormal level. If anything, it's sort of like, I'm going to work out, I'm going to be healthier in January, whatever, right? It's kind of like you're going to clean shop, clean the business a little bit, clean the pipes a bit. It's not like we saw in January of 2023 or the end of 22 or the mid of 22. Not even close. So, and that's in terms of companies with layoffs is the blue line. And then, of course, you look at the orange line for actual employees laid off. So, rolling recession, totally agree with. I'm more bearish that we're going to get rapid layoffs, and I'm also way more bearish on the banks. I'll have another video coming out later on the banks. I don't want to go too long here, but I think there are way more issues in the banks that haven't really been flushed out yet. And this idea that, it's just individual banks that are having problems. I don't know. I think the end of the bank term funding program is going to lead to a big oopsie-doopsie daisies when it comes to the Fed realizing, crap, we don't have the bailout facility. They're going to have to open it again. I really think they're going to have to open it again or cut rates. Because if you cut rates, then you'll essentially raise bond valuations, which should also raise mortgage-backed security valuations, which basically acts as a float for these sinking banks, right? It's like putting a buoy under the sinking banks. Let's pretend this cup is a sinking bank, okay? And like default is here, like going bankrupt. And these banks are like, oh my gosh, okay, we underwrote the multifamily portfolio at a lower level, offices at a lower level. Okay, but what if our underwriting's wrong and it gets worse? Oh no, the bank term funding program's gone, right? And we're getting close to that default level. And then what happens? Fed cuts rates 25 basis points. Oh, all the bond valuations just got written up. Oh man, that was a close one. Oh no, more defaults. Oh, Fed just cut again. Got to prop up the Ponzi. So, I don't know. It's going to be really interesting. But I have to say, fascinating meeting. I like getting out there physically, in person with people and hearing their opinions. I also, shout out to what we heard about Jamie Dimon. Jamie Dimon's a big fan of getting out there, meeting his people, meeting his analysts. Loved the meeting yesterday. It's very insightful. While I don't agree with every perspective, I don't think anybody ever should. It's interesting. It's a point of view and well-constructed point of view. Interesting comparison to China in 2008 in America. And also, obviously motivating, but is there a potential bias risk? Of course there is. Is there, a play of going long interest rate sensitives? Of course, but could there be more pain in that? My POV? Yeah, potentially. And then big shout out to the analyst team over there. They've got a great crew, a great group of people. Kind of cool. They really put their analysts. If you want an internship at JP Morgan, hard to get into, hard to actually stay at JP Morgan and get a lot of work to do. But boy, it seems like once you're in at JP Morgan, you got a good career ahead of you. So kind of cool. But anyway, that was my takeaway, and I want to share it here. Let me know what your thoughts are. I'm curious, and see you next one. Bye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker.